9 months of inventory. The Greater Vancouver Real Estate Board is sitting at over 9 months of inventory at the end of September in 2025. I'm Christine Kopr with Sotheby's Realty, and if you've been following me, you know that that's a heavy buyer's market territory. 6 months of inventory and above is considered a buyer's market. 6 months of inventory and above is considered a buyer's market, and we've been in a buyer's market since July of 2024. So you might be wondering what's happening in the market today. So let's dive in and get through all of the September numbers and a little bit of an update on the rest of the Greater Vancouver real estate market. So for those of you that follow me every month, I go through this table because it gives us a quick snapshot of what's happening in the real estate market in Greater Vancouver. This goes from Vancouver all the way out to Maple Ridge. It doesn't include the Fraser Valley market, just as an FYI. So we're focused 100% on the Greater Vancouver market. Let's dive in, rock through these numbers, give you some context, and then go into some more details. September finished off the month with 1,875 sales. That's down 4% month over month, but up year over year. So interesting stats. However, I'm not surprised. August is typically the quieter time of the year. It's that last month of summer that everybody tries to take off. And year over year, we're up slightly, which is a very interesting note about September. Now, one thing I did want to mention is September is the month that it starts the fall market. This is the second busiest time of the year, and the activity is muted. However, having said that, we saw the same thing last year, and then we saw sales take off into the 24 to 2600 range in October, November, and December last year. So we have yet to see what happens. If sales continue to remain muted and the listings continue to come on, anticipating that fall market, the second busiest market of the year, then we might see even more downward pressure on prices. However, if they start to tick up and start to chew away at some of that excess inventory, then things will probably stabilize. However, you can see that the trend has been fairly slow and steady, but with moderate upticks throughout the year. Now, one of the numbers I really like to take a look at is the 10-year average. How does September's sales compare to the 10-year average? They were down 20% below the 10-year average. However, this time last year, we were down 26% below the 10-year average. So it shows that we are still in very muted demand side of the equation. However, we are doing better than we were last year, but nonetheless, it is weak activity overall. We've never cracked over 2,300 sales in any month this year so far. So the question is, will we see that this fall, or are we going to continue to see low sales bumping between 18 and 2,200 as the year goes on? New listings clocked in at 6,500. That's up 54% month over month. Not surprising, given that you're coming off August, and up 6% year over year. So a bit more inventory or new inventory coming on in the month of September compared to last month. That is up 20% above the 10-year average. So more listings coming on than usual. And compared to last year, we were only up 17% over the 10-year average. So while we're slightly better on the demand side of the equation, we're also slightly higher on the supply side of the equation. And when it comes to overall listings, we're now sitting at 17,079 homes available on the MLS at the end of September. That was up 5% month over month, up 14% year over year, 36% above the 10-year average. So it just goes to show we are still sitting in a very excess supply side of the equation. If you've heard the real estate industry talking about over the last few years, is that it's not just about demand, it is about supply. And we definitely have more supply than we ever had in the last 10 years available for sale in the Vancouver market. And again, it's more than it was last year. So in 2025, the story is just overall more inventory and less demand, and a significant lower amount of demand for our real estate, creating this downward pressure on prices. Now, This is not surprising given the fact that in 2025 and 2026 are the two highest years of the mortgage renewals into this higher interest rate environment. You may have heard of it called the renewal cliff that a lot of people were scared about. That point in time, in my personal opinion, into this extreme high interest rate environment has passed when clients were buying or renewing into 6+% interest rate environment, which was over a year ago. But the volume of mortgages turning over in this lower rate environment still higher than they were than the rock bottom rates in COVID. Now we're sitting at about 4% versus, 2% is much more manageable than it was when you were renewing into 6% interest rate environment. The volume of mortgages that are renewing into this environment is still extremely high. And it's not that people can't necessarily afford those mortgages. It's just that for the investor segment of the market, which I would like to reframe the investor market, it's the mom and pop owners of real estate that provided rental housing to our people because the government had not been providing rental housing since the 70s. The last time they were involved in stimulating and creating housing was the 70s and 80s and that sort of thing, and then later turned it on into the private sector, which is then your mom and pop investors or developers. So we can't really criticize them for buying and renting out homes because without them, we wouldn't actually have any supply until now. The challenges where we are today in turn of like, why do we have so much supply and why do we have so much inventory coming on the market? Well, I think a big factor is that the numbers don't pencil. The private sector doesn't build or invest in creating homes that don't provide a return on investment, just like you wouldn't go out and buy a home and then rent it to someone and then, have to subsidize the rent every month because of all of your costs, which is how it works essentially. And so we don't have that investor market in the segment anymore. So that demand's not there. And then those properties that are rolling into this new environment where rents are lower, so your revenue's down and your expenses are up, including your interest payments on your mortgage, as well as just overall taxes and insurance and etc. It doesn't make sense to hold on to these properties anymore. And you're seeing a lot of that come to market. I think that's one segment of why we see so much more inventory. There is also less immigration. As we know, we've had some very questionable immigration policies that really stimulated the demand side of the equation. And now that has been toned down and we're just not seeing as much demand. And of course, the affordability piece is another factor where it's just expensive to own homes in Vancouver. And you have to have enough income to be able to qualify or have been in the market or have some kind of help to enter the marketplace if you're not in it already. If you were fortunate enough to get into this market 10 years ago, then you're still ahead with your equity. Anyhow, point is we're seeing a lot of inventory come on the market and it's accumulating over time. And then just the demand side's just not there, which I think were all the government policies or many government policies that the voters had voted for. They, voted governments that wanted to see taxes and anything they could really do to slow down the demand to help lower housing prices, which is exactly the effect that we're seeing, as that is a big part of the equation, whether it's taxes, immigration policies, and just all the economic reasons why people would want to be in Vancouver and or Canada. And a lot of that's shifting, and we're seeing a lot of people moving out of BC and into other provinces or into other countries. And in addition to that, we also still have things like the foreign buyers ban and the foreign buyers tax. And remember, there's different ways of looking at foreign investment, right? I think a lot of people in the media have done a really good job of pigeoning foreign investment and foreign buyers as these people who don't live in this country who buy, 1, 2, 3 condos and all cash, and then they just let them sit there, or they turn them over and into, keep raising the rents to increase the incomes, and they really have like no ties or they don't do anything in our marketplace. But we actually have foreigners that are people like Americans who currently they're looking at their political situation going, you know what, I'm an educated person, perhaps I'm a doctor or a highly skilled person or an entrepreneur or a business person. I'd like to move out of my country and go to another safe, stable environment. But unfortunately, we don't allow those people to enter our country. So, or they can, but they're not not allowed to own real estate here. And for that segment, typically they want to know that they can actually own their real estate versus renting real estate. And so it's just some of these layering policies that, have helped create the result that the votership was seeking. Therefore, if you're considering getting into the market, it could be an excellent time. So 17,079 homes is the total amount of homes available on the Greater Vancouver board at the end of September. That was up 5% month over month. Sellers coming on in anticipation of the fall market, and up 14% year over year. So we definitely have more inventory this time than we did last year. And just to give you an idea of in context, because year over year doesn't always give you the complete picture, we're up 36% above the 10-year average for inventory. So finally, we have that supply that everybody's been hoping for. And you can see that it's substantially higher than it was last year when we were only 24% above the 10-year average. Months of inventory. Why do I love months of inventory? Because it is a precipice, or it gives you an idea of what's coming next for prices. Between 4 and 6 months of inventory is considered a balanced market. 6 months and above is considered a buyer's market. Why? Because it would take 6 months of sales to get through all of our inventory, and therefore there's a lot of inventory putting downward pressure on prices. In this case, we're hitting 9.1 months of inventory at the end of September. We have not had this much inventory except for in the months of December and January of 2019 going into 2020. It was a difficult time. Prices really came down. What's interesting about that is, besides that point in time, we hadn't had that much inventory, like months of inventory, since the GFC. So it gives you a really good idea of what's happening in the marketplace. Another interesting point is that shortly thereafter, so December, January of 2019 were the months of where we saw over 9 months of inventory. And right after that, by March, COVID came along and we went straight back into a seller's market and only had 4 months of inventory. There was a lot of demand. The psychology was quite positive at the time prior to COVID. And slowly but surely, the demand came back, chewed through that inventory, and the market did flip around. Are we going to see such a quick, dramatic shift in the market psychology this time around? I would argue not so much. The dynamics have changed. The overall structural situation has changed. Not only do we have excess inventory on the resale market side, but we also have excess inventory of unsold brand new condos sitting out there, what developers need to sell and get off the books. And at the same time, because they're having such a hard time selling these newly built condos, they're starting to either shelve, like not proceed, or cancel projects that just are no longer economically viable. So in my personal opinion, I think we're going to be sitting in this marketplace for a while, given we have a lot of inventory, and we're going to continue to have more inventory from the resale side, as the numbers don't really make a lot of sense. And we are still going through this massive renewal turnover, and anyone that was an investor is probably, strongly considering letting go of those homes because they just don't financially make sense. Now, benchmark price is sitting at 1.142 million. That's down 1% month over month and down 3% year over year. We've been chipping away at this benchmark price. So one would say that it's been fairly stable in the marketplace, but I would say after you have 10 or 12 months of 1% decreases, now you're down 10 to 12% over time. So we haven't seen full 1% decreases necessarily every month. My table here is rounded up. Sometimes it's 0.4% decrease, sometimes it's a 1.3% decrease. But the fact is prices are being eroded away slowly but surely in most segments. So now we're going to take a look at sales to actives ratio. So 12% and below is considered a buyer's market. 20% and above is considered a seller's market. So 20% and above, seller's market. 12% and below is buyer's market territory. Let's have a look. Okay, Westside, Vancouver detached is sitting at 7%. So we're well into a buyer's market and it's been there chugging along all year long. What I think is really interesting is a year ago we were sitting at 10%, while clearly underneath that 12%. So buyer's market territory, you can see it dipped down, had a little bit of a bit of a momentum here and has settled back down at 7%. Definitely West Side houses are a great opportunity right now. Now, keep in mind the best performers are Kitts and Mackenzie Heights at 16%. So they're actually sitting in a balanced market territory. And some of the worst performers, False Creek and Fairview and Mount Pleasant, there's not a lot of actual detached homes in these particular locations. So they're not a very good representation of what is in a buyer's market territory. But I will say that Shaughnessy is sitting at a 2% sales to actives ratio. It has 90 available homes on the market and only 2 sales last month. So that gives you an idea of how poorly that market segment is doing. So if you are looking for opportunities, this could be a great place for it. Westside condos, we're sitting at 12%. So just on the cusp of going from a balance to a buyer's market. Your median price here is $884.50. Your best neighborhood is False Creek in a seller's market, 23%. And your worst performing markets are Arbutus, Mackenzie Heights, Mount Pleasant, Shaughnessy, and Southlands. No sales reported for Westside condos or townhomes. Remember, some of those locations don't really have a lot of that product, but Arbutus and Mount Pleasant do. So something to keep in mind. Downtown condos and townhomes is sitting at 11%. Balanced market, I would say this is actually now more of a buyer's market territory. Yaletown was your best performer at 15%, and your worst performer was Coal Harbor at 7%. It was so definitely in that buyer's market, but overall sitting at 11%, and it's been fairly steadily sitting just coming out of that balanced market into a buyer's market territory. So there's definitely some opportunity in the downtown core, but not as bad as one would think in terms of overall relativity. But of course, it will depend on the location of the condos that you're looking for. Vancouver East detached is sitting in buyer's market territory at 9%. You can see it's been kind of bumping around. It bumped up into like some solid balanced market territory for a while, but really we've been sitting in the buyer's market territory and it ticked down into September as well. Again, we're seeing that the downward pressure on prices there. Your best performing market was Hastings Sunrise at 21%, just inside that seller's market band. And your worst performing markets were Downtown East, Hastings, and South Marine with no sales reported. Definitely a lot of inventory in those pockets, particularly South Marine. Vancouver East condos, actually one of the best performing markets, sitting at 16%, balanced market territory. Your median sale price is about $650. Your best performing market is Renfrew at 41%, which is definitely in a seller's market. And then your worst performing market is Killarney and Fraserview. No sales reported there whatsoever. Again, not as many condos, but there are condos in these pockets. So definitely a representation of how undesirable some months some of these neighborhoods can be. So again, not necessarily undesirable, but maybe not the right product and or not the right pricing, providing some opportunity. But you can see here we've been in more balanced market territory for Vancouver East overall. For your specific market, make sure you reach out so we can get you the market snapshot of your target market today. Now let's see where the opportunities are, because while there has been downward pressure on prices, here's an opportunity to actually visualize what this really looks like. Year over year, Westside detached, you're now sitting a benchmark of 3.264,900. That's down 6% year over year, or down over $200,000. So if you were thinking about this market segment a year or two ago, now you're able to buy it $200,000 cheaper and much cheaper than off the top when we were peak market in 2022. Townhomes benchmark are now sitting at just under 1.4, down 1.5% year over year, or just down $21,000. And condos are sitting at 804,000, down 4% year over year, or $34,000. So they've all just got that much cheaper if you like this product on sale. Vancouver East detached is sitting at 1.756 for your benchmark price, down 7% year over year or $135,000. That's a nice sale. Townhomes, 1,048,000, down 9.3% year over year or down $100,000. So those east side townhomes are definitely feeling a bit of that pinch, which makes for really great opportunity if you're looking to upgrade from your condo into your townhome, for example. There's definitely move up buyer opportunity here, and I'll get into that in a second. Eastside condos benchmark is sitting at 673, down just under 2% year over year or down 12,000. Now, for those of you that are thinking, well, it's a down market, what's the opportunity? I'm going to not get that much money for my place. But the point is you're going to sell for less, but you're going to buy for less. And in fact, there's a real strategy here because, for example, if you're living on the east side and you have a condo that's sitting at 673, or that's your benchmark, and it's only down 12 grand, if you're in the position where you're able to sell it and move up into that townhome that's down 100 grand, you're still going to be ahead between $90,000 and $100,000 when you consider how much cheaper you can buy that townhouse for today versus the small depreciation you've experienced on your condo. Or if you're sitting in a Vancouver West townhome that's only down 20 grand and now you're ready to sell that at about 1.4 and jump into, say, an east side detached, which is down 135. So you might be down 20 grand on your condo, but you're going to be buying that detached property for $135,000 less. So there's definitely an opportunity here for move up buyers. Reach out to us so we can do a custom CMA on your property and take a look at the product you're looking for and to see what kind of move up opportunities are out there for you today. Now we're going to transition into the overall market conditions and what's happening with inflation. Now we're going to transition over into what's happening in the overall marketplace, which influences sales, inventory, and the Vancouver marketplace. So as a reminder, we do have a lot of inventory. When we were talking about our inventory previously, you can see that there's a lot of units under construction. They haven't even started completing. So, a lot of those properties are going to start completing, and we're going to see even more inventory coming on the market. Now, granted, this isn't necessarily going to be inventory for sale because we have a historic amount of rental product coming on the market. Given the government incentives for that product, there was financing for private developers to go and create rental. So a lot of developers who were making for market housing converted over into rental or just focused on that segment because it was the only one that made financial sense to do so. So we are going to see that product coming on the market. It is also partly why we're starting to see softening of rents besides the out migration or the lack of in migration coming into our city. And into the province, you have less demand, more completions, and more inventory around, and therefore there's the supply, and it's putting some downward pressure on pricing and rents as well. Coming back, though, to some of the developer inventory, we are starting to see some pretty interesting opportunities out there. So make sure you reach out to us, particularly if you're a first-time home buyer. For example, there's brand new condos like this one, Park George. This is in Surrey, right by Surrey Central, and actually King George SkyTrain station, which is one of the nicer pockets, being fully redeveloped with brand new high rises, a SkyTrain station. UBC is eventually moving their medical facility, training facility out there. You have all of the universities at Surrey Central, and you're getting these brand new high amenity buildings with, one bedroom, 500 square foot condos in the $500,000 range. If you can pick one up for 500 grand and 5% down is only $25,000, which isn't a lot of money to get started in the real estate market. Now, for some first-time home buyers, that may not be their ideal location to be living, but sometimes you just want to get your foot in the door. Or if the rents work and you look at it as an investment opportunity, it's another way to get started. But in this case, there's particular incentives like 0.99% interest on a mortgage, on a 3-year mortgage being offered by the developer. In this case, it must be your personal residence. I suspect this is going to be a mortgage buy down opportunity. And there's also a $35,000 credit, I believe, from EQ3 furniture packages. So you can come in and have a swanky pad at some particularly attractive prices for the next 3 years, which could be a great way to get in your home. Because of the low interest rate, you'll pay down your mortgage much faster because each mortgage payment will be attributed more to principal than it will be to interest due to the interest rate. And it could be a really great way to get your foot in the door with respect to real estate. If Surrey's not your thing, reach out to us and find out what kind of one-bedroom condos are out there at what price point, say downtown Vancouver, because remember, downtown Vancouver is for sale. There is a lot of condo inventory, and it's probably one of the most prime places to live. CPI, so how's inflation doing? Inflation has been behaving. We had a tiny uptick in the last month of reporting, 1.9 up from 1.7 the month previous. However, it's still well below the, happiness band of 2 to 3%. And while it shows a little bit of inflation, there are market participants that believe it's kind of a short-term blip, and we're going to continue to see softer inflation, even with the results of the tariffs. You can see Canadian monthly GDP is starting to roll over, and we hear a lot about how our economic productivity is quite low, and these are concerns for the Bank of Canada, which does influence their decisions with with their interest rate decisions. Unemployment is another big one. We are seeing a slight uptick in unemployment, 7.1 holding strong across for Canada, 6.4 in BC. We did have a jobs report of gaining 60,000 jobs. That was quite unexpected, but we've also lost 100,000 jobs throughout this year. So really, we're still in about a flat position given the overall activity that's happened in the economy. And then I would argue how many of those jobs are actually private sector versus, public sector. So again, the concerns around the economy continue, especially with this extremely high unemployment rate, which we haven't seen in years, excluding COVID. Now, Bank of Canada has been discussing that they might change the way that they make decisions about their interest rate policy. So in this case, they're thinking about abandoning core inflation as their preferred measure. This is something to keep an eye out for. And I have a feeling it's the balancing act that the Bank of Canada is facing, where we know we have economic weakness and they want to lower interest rates to stimulate the economy and stimulate business. But on the same token, they're concerned that we're going to stimulate inflation. And if we have an inflation, which is one of their key preferred measures of what to do with their policy, that if inflation ticks up, they would have to continue to keep interest rates high or lower them. And perhaps what they're doing is they're giving themselves a little bit of a wiggle room where they may feel they need to lower those interest rates, may see an uptick in inflation, but not actually have to act on it because they need to stimulate the economy. And part of this too is because the changes that they make aren't instant. They don't instantly affect the economy. They have to see how their interest rate policy changes impact the market over time. And by removing this potentially as a decision-making key criteria, it will give them the flexibility to maneuver the interest rate in ways that wouldn't normally be expected if they had only focused solely on core inflation. So to be determined. The next Bank of Canada interest rate is October 29th. Some banks are predicting another decrease to help stimulate the economy, and we shall see. We had a strong jobs report. However, we still have weak inflation, which means the economy is not hot, and there's no signs of strong economic activity to come. What do you think? Is there going to be another interest rate decrease? We shall see. But the Bank of Canada only impacts your variable rate mortgages and doesn't impact your fixed rate mortgages. The 5-year Canada bond is what controls your 5-year fixed rates. And you can see that since July, we've been on this steady eddy trajectory down. So we're probably going to start to see some lower fixed rate terms. We have been hearing 3.9 to 3.99. Those would be very good rates. And we might see a lot more of that. So It's interesting because the variable rate and the fixed rates are continuing to be very close. And now you have to decide, do you want to lock in some certainty because we could see some inflationary pressures, especially if interest rates do come down or the Bank of Canada lowers its rate to stimulate the economy, and of course, the impacts of the tariffs on our imports. All right, well then, that's it for our Vancouver market update for the month of September 2025. Definitely, there is opportunity out there for our first time home buyers, move up buyers, and it's all about strategy and understanding where the opportunities are. We would love to help you. Please reach out to us with any of your questions or complimentary CMA if you want to see if there's an opportunity for you to make that move. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC, and I look forward to seeing you next month.